Investing is all about finding the right balance. The Net Group Investments Balance Fund helps you to do just that. It's managed by our best-of-breed partner, Truffle Asset Management, an independent award-winning boutique fund manager. Due to their size, Truffle can make faster, more agile investment decisions than bigger, more cumbersome fund managers. With their finger on the pulse, Truffle Asset Management take risks seriously. They understand what's more important and prioritize protecting investors from the downside risk wherever possible. Their proven success lies where it counts the most, choosing the right investments at the right time and diversifying the fund appropriately in different markets. The Net Group Investments Balanced Fund isn't just another balanced fund. Due to its composition and its ability to hold a different mix of stocks, the fund offers excellent diversification benefits, making it an ideal addition to any portfolio. The result speaks for themselves. The consistent application of their robust investment process has led to peer group leading performance since the inception of the fund. That's how you know. When you invest in the Net Group Investments Balanced Fund, you're partnered with the best. Visit netgroupinvestments.com or talk to your financial planner for more information about the fund. Net Group Investments. See money differently.
Good morning, everybody, and thanks for joining us today for the July edition of The Balanced Perspective. As usual, I'm your host, David Levinson of Net Group Investments, and we're joined by Ian Power, CIO of Truffle Asset Management and manager of our Balance Fund. Ian, thanks so much for joining us today.
Morning, David, and good morning to everyone on the call.
Ian, as you can see, dialing in from home today. Unfortunately, we're not allowed into our fancy office studio anymore, so apologies in advance for any barking dogs. Or if my communication drops for that matter. I guess the perils of working from home. So fingers crossed technology is on our side today. Before I get to the first question, Ian, just to recap, I guess, what we've spoken about in the last 3 months. We picked the brain quite deeply in terms of what's happening with the US Treasury yield curve. I think that was back in April, if my memory serves me correctly. And then in May, we spoke about climate regulation on the back of the big meeting that Joe Biden hosted at the White House. And then in June, or at least last month, we went quite deep in terms of where we are from an inflation point of view, and that's both in the US, globally, and particularly here in South Africa as well. So the topic this month, I chose something a little bit more high level, what's happening from a financial market point of view. So again, always appreciate you taking these 15 minutes out of your day to answer some of our questions. So without further ado, the first question speaks largely to the topic today, which is the Great Rotation. I think at least globally anyway, growth stocks have really dominated the market for much of the past decade. And recently we've seen the value sector maybe close some of that gap from a valuation point of view. I also appreciate that, the growth value discussion can be an oversimplification of the market. But what can we attribute to this rotation to? And was the timing of it largely expected, or did it catch many market participants off guard?
Thanks, David. I think you're right. The last 10 years has seen growth really outperform value. And, by all accounts, that differential in terms of the level of outperformance has been unprecedented. And, I guess the move in some of the value stocks that we saw in November last year was catalyzed by the announcement of a vaccine. And I think what really happened then was the certainty of a pathway to a return of normal business conditions, normal way of life, with the prospect of people getting vaccinated, really unlocked some of that deeply distressed valuations that some of the more economically sensitive shares had been priced at. And you saw that sharp knee-jerk reaction from a lot of those value shares, a lot of which had been sold down 50, 60%, with the prospect of some sort of normalization of the underlying economy in the future as and when people got vaccinated. And I think the other factor, supporting that, and I think, perhaps, still to come, is the fact that the level of stimulus and support that governments have injected into their economies, both through ultra loose monetary policy, in addition to unprecedented levels of fiscal stimulus, we think will provide a runway of a fairly robust recovery in terms of the global cycle, which means that those value stocks or those economically sensitive stocks should start to enjoy pretty strong earnings recoveries, and we've already started to see that. And I think that's what investors will get excited about, is in a world where suddenly there's a lot of growth to be had because of the recovery in the cycle, you tend to see investors start to switch out of more expensive growth companies trading at higher multiples because there's a lot of growth available, and you can buy into that growth and that recovery through some of these value economically sensitive shares where you're not having to pay such a high multiple with the likes of some of the tech and some of the L'Oreals and these high quality growth companies. And I think that's what you're starting to see. And obviously we've had US long bond yields which have kicked up a little bit, sort of consolidating around the 1.5% level, but we think that there's definitely more to come on that space as people get more and more comfortable with the economy opening up and things returning to normal. And we think that the opportunity for investors to still buy into some of these more attractively priced value / cyclically exposed companies still remains on the table. So I think by and large that would explain why we've seen that. Having said that, there are two sectors in the classic value category which are being disintermediated, both financials, banks by the new challenger banks and the online payments technology, etc. So you've seen a sort of a derating in many of those companies, and then the energy companies as well, with the world pivoting, starting to pivot away from fossil fuels. Those businesses haven't been able to grow earnings to the extent of many of the others. So they make up big components of those value indices. And there's an argument that, there is some sort of permanent dislocation that's taking place in their fundamentals. But notwithstanding that, I think there are pretty good prospects still for some of the value economically sensitive shares vis-a-vis expensive growth / tech shares.
Great, thanks so much, Ian. And I'm glad that you mentioned banks and some of the energy companies. If any of the listeners out there would like to go have a listen, I think it was our May edition of our Balanced Perspective where we delve quite deeply into those two sectors, specifically around climate regulation. But one of the things I've really enjoyed about hosting these sessions over the last 7 months is I've had to dust off my Economics 101 textbooks, and maybe very much the same for today. If we were chatting to an investor in the US, they might view growth and value a little bit differently to, for example, a European investor or an EM investor. So before my next question, maybe just to serve as a reminder to myself and the audience out there, what JSE sectors would one regard as growth? And then conversely, what would one regard as value from a South African point of view?
Yeah, so I think from an SA construct, clearly we've got a much more limited investable universe. So the opportunity set of growth companies would be much, much smaller than that on a sort of a global grandstand. But I mean, typically you're looking at businesses which have been able to sustainably grow their earnings despite the cycle because of whatever factors are affecting either the company or the industry. And, the list in South Africa would be pretty short. So, it would obviously include the likes of a Naspers, possibly a Clicks, Transaction Capital, just thinking of a few of those companies. But I guess the problem in South Africa is we don't have a big tech sector, or, typically if you look at those growth sectors that you've got globally, we don't have similarly those well-developed markets or the ability, to capitalize on those opportunities that you do overseas. So I think when one compares from a South African point of view to a global point of view, typically the themes of like health and beauty. Yes, luxury, we do have Richemont, but, the hard luxury tends to be a little bit more cyclical than compared to an LVMH in terms of their softer luxury. But we don't have companies like L'Oreal, we don't have some of the biotech companies and some of the tech companies that you do have offshore. So we're relatively limited, but there are still, a few companies that I would classify as growth. I mean, Bidcorp would be another one. A food service business, which is, probably the biggest food service business outside the US, and that was spun out from Bidvest. But no, you're right. The reality is the growth pickings from a South African context are much more limited. And I suppose, that's why many portfolios we've had big exposures to Naspers over the last decade, really because that is the only I suppose big tech name that we have that one is able to invest in and get some of those attributes. Whereas if you're sitting offshore, you've got the ability of that entire universe, rather than just a few limited names in SA.
Yeah, thanks so much, Ian. I'm glad you mentioned some company names here. I think something we haven't really delved into too much over previous sessions, or the perspective is company-specific news. I want to keep it local again for probably my final question is, which counters have benefited from, I guess, the release of the lockdown, but more importantly, the rotation that we're seeing into value? Because I imagine it'll be a function of this broader market trend that we're seeing, the monetary stimulus that you spoke about earlier on in the session, the company valuations, the strength of their balance sheet, etc., and cash flow generation, I guess, in light of the lockdown. So which counters have really benefited from that? And then maybe give us a sneak peek into your investment team in terms of their thinking and which sectors are yet to experience value unlock and maybe continue to pose an attractive opportunity here in SA.
Yeah, so I think, stocks which have done well. I mean, many of the SA Inc. names post the November vaccine announcement experienced very sharp re-ratings. So I think the first leg of that recovery in prices happened in that sort of 3 months after November, where you saw, sort of circa 50% upward moves from those low levels. But I think what we've seen of late is we've seen, SA companies delivering better than expected earnings outcomes. And I think that's pretty much across the board, really as a function of decent cost management in terms of the businesses. So during COVID, I think the uncertainty in terms of the operating environment, you saw many SA companies take costs out of their businesses. And then we've seen a much sharper recovery in the economy than anticipated. The economy has been a lot more robust. And I think that talks to a stronger and faster global recovery, which has powered the commodity cycle. And our primary sector has really benefited from that to the extent that you've got high commodity prices. And we've had a really great agricultural season once again. So I think these are factors which have created a sea and an environment where our local companies, certainly notwithstanding COVID, have had a benefit from that. And that has come through in terms of their results. But I think there's been very clear winners and losers in terms of, companies coming out of COVID. And I think, still companies in the services sector, I think tourism is still on its knees. There's still very clear areas where there's a strain in certain businesses, but in other areas of the market, for example, there are companies that have benefited from COVID, and I guess benefited from the way in which consumers have changed their behavior. So to give you a few examples, our consumption of broadband and data, you've seen better than expected numbers from some of the mobile companies, particularly on the data side, including the likes of a Telkom, which we would own in the portfolio. You've seen companies like Truworths, Foschini's, and Woolies to a certain extent lose share in that formal fashion wear, as well as the workwear space, where people are now spending more time at home. We're having to buy less formal wear and less workwear and more leisure wear. So I think you're seeing some changes taking place, and perhaps the extent of those won't continue, but I think there is an argument to say that there's going to be some sort of flexible working ability for people, and I think the demand for leisure and discount fashion has grown, and you've seen the likes of a Mr. Price, a Pep, take significant market share. You've seen the likes of a Cashbuild and an Italtile recording record sales on the back of us spending more time at home and people renovating their homes, their offices, and the fact that we're not able to travel, so that excess discretionary income has to go somewhere. So I think there's been some very clear winners and losers, and yes, vaccines are here now, and they're rolling out at 150,000 jabs a day. We're hoping to sustain that, and that should bring the prospect of some sort of normalized, environment in terms of the way we behave and travel, etc. But I do think that there have been some changes. But notwithstanding all of that, there are definitely opportunities in the SA space. We think the healthcare stocks still look very attractive. We think some of the financial shares are trading still pretty cheap relative to their historic price to books. Very robust balance sheets, as you've said. And we think, generally SA corporates have weathered the storm well. And, in a sea of equity markets globally where value is hard to find, in other words, they're all pretty expensive, South Africa stands out as being fairly attractively priced in the context of expensive global markets, with the prospect of decent earnings growth and better than expected earnings coming through. So I think, we just need a few things to fall into place for us. Obviously, Wednesday is important. Let's see what happens with Zuma. Let's get this vaccination rollout going. But certainly there is some value on the table from some of these SA assets.
Great, thanks so much, Ian. I think you've given me an idea for the next balance perspective. Maybe something we haven't spoken about before is the food system here in South Africa. Because you did mention the decent rains we've had. I think we've had the second highest harvest ever in terms of our local maize, and maybe even wheat for that matter. I stand to be corrected. Yeah. But as always, thanks so much for your time this morning. The 15 minutes flew by. I really appreciate it, and take care, and all the best to yourself and the team there.
Thanks, David, and thanks to everyone on the call.
Right, and then as everyone knows, I'm usually scribbling away, but I was typing away today on some of the high-level takeaways from Ian's comments and answers. So the certainty of a vaccine pathway unlocked some of those deeply depressed valuations, and then coupled with the local government stimulus, this has aided those economically sensitive value stocks, which is why we're seeing that gap close to some degree between growth and value. In terms of South African growth, the exposure here on the listed JSE is Naspers, Clicks, Transaction Capital, and the likes of Bidcorp as well, but really a few options locally. Most is very much linked to the value story. The South African economy has proven more robust than many anticipated, led by exactly that, our primary commodity sector. But there remains plenty of opportunity still in South Africa from an investor point of view. So from myself, David Levinson, thanks again for joining us this morning. I believe there will be a QR code popping up on your screens. And as always, your feedback is greatly appreciated. So for myself and the rest of the team here, enjoy the rest of your day and take care. Ciao.